Good morning from our global headquarters in New York. I'm Manny Scranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set that agenda.
No pain, no gain. President Trump declines to rule out a recession and says the U.S. faces a period of transition. Those comments weighing on Treasury's equity futures down into the red after stocks posted their worst week since September. And Canada has a new prime minister. Mark Carney demands respect from the U.S. and vows to take on the tariff fight. Good morning, Manus.
Danny, good morning. It was a brutal week for stocks last week, and we start on the back foot this morning, down 3% on the S&P 500, the biggest weekly fall in 6 months. We're starting the fourth week of decline in these equity markets. The Nasdaq already in correction. Well, it blipped into correction on Friday. If we continue at this pace, we will be firmly there. Laurie Calvasina at RBC says a garden variety pullback has finally begun. The risk is now these markets draw down 14 to 20%. Roll it over to the bond market. Extreme movements have been the real narrative here. We've gone from exuberance to despair. And of course, this tariff risk is now from an inflation risk to recession risk. We've got $119 billion worth of 3s, 10s and 30s, along with the CPI and the PPI later this week, coming in the bond market. 424, Danny.
A busy week to come. Don't forget University of Michigan sentiment survey also coming too. We've got some individual stocks we're keeping an eye on, along with the whole risk-off thing we're seeing in markets. Bitcoin is also falling. That's affecting crypto stocks like Coinbase, down 6.5%. It is now the fifth consecutive session of losses for Bitcoin. Some of the negative sentiment came last week when President Trump's executive action on a crypto reserve led to some disappointment,
to say the least. DoorDash Rising, as the food delivery company, is being added to the S&P 500 index along with Williams-Sonoma, TKO Group and Expand Energy, all in.
Finally, wrapping things up with some luxury. Ferragamo getting a nice little bounce back intraday, up 2.7% in the Italian trade. But that is mostly because it had its worst ever plunge on Friday, falling nearly 16% after issuing a weaker than expected outlook.
And in just a few moments, we'll catch up with Andrew Sheets of Morgan Stanley, and later in the hour, Terry Wizman of Macquarie Group joins us. Danny, there's no doubt about it. We are on the back foot this morning. I like what Ed Yardeni said late on Friday. We're wondering whether Trump tariff 2 turmoil might trigger a rare kind of flash crash that then almost triggers the recession, or is accompanied by a recession.
Well, you have this concern that 10% of the world's wealth spend 50% on corporate spending. So is the wealth effect a bigger issue? And I think that's kind of what Yardeni is getting at. You're seeing that kind of recessionary language start to creep in. JP Morgan has upped their recession odds to 40%. Morgan Stanley has downgraded what they say is GDP of this and next year. The growth concerns are starting to become real.
Yeah, and the vibes are shifting as well. You just look at the commodity market, you look at the oil market, and that really begins to scream something much more aggressive. You've got JP Morgan talking about $50 oil. That is well into the downturn kind of numbers. But the Trump administration, it's starting to hint that the president's economic plans may cause some short-term pain. POTUS has not ruled out a slowdown in the U.S., saying, quote, this: there is a period of transition because what we're doing is very big. His Treasury Secretary, Scott Bessent, has sung a similar tune over the weekend, saying that there's going to be a detox period. And here's what Andrew Sheets of Morgan Stanley says. The market impact. We think there are signs of weakness in the hard data. It will feed into recession fears and challenge the resilience of credit. The beta should increase on further drawdowns. Please say Andrew joins Danny and I this morning. He's the global head of corporate credit research over at Morgan Stanley. Look, these recession fears are rising. The count is rising. We're at 30% by some of the analysts. What is the risk of this potential flash crash triggering recession? And therefore, do you prepare for some kind of significant repricing in credit? Andrew.
Yeah, thanks. Good morning. So look, I think we need to take a step back and think about kind of the dynamics of what's happening. And so, you know, our initial assumption, kind of if we think back to the end of last year, was that the Trump administration would make these larger policy changes to tariffs and immigration, but they'd be somewhat slower to occur. And so the economic impact would occur somewhat later. And so for an asset class like credit, where you still had very strong demand, you had attractive yields, it could be somewhat more resilient. And I think really over the last month, we've seen an administration that's pushing harder and faster on tariff and immigration policy. And that's causing real fundamental change in terms of how we at Morgan Stanley are seeing the U.S. economy. We are effectively bringing forward some of the slower growth and stickier inflation that we saw kind of happening later in the year and into 2026. We're bringing that forward into 2025. And that's happening in the context of a credit market that's been very resilient, that's in some ways ignored the weakness you mentioned in the commodity markets, the weakness we've seen in cyclical stocks or small cap stocks. And so I think that's the vulnerability. It's not just that our fundamental expectations at Morgan Stanley are getting worse. If we think about our base case, it's that specifically for credit, it's really kind of been surprisingly, impressively resilient. That rubber band is stretched a lot, and we're worried it can't stretch anymore.
What does it actually take to make the rubber band snap, though, Andrew? Because you probably could argue that seeing risk assets, except credit, do as poorly as they have 3 weeks of selling. I think if you said to someone you'd get over $70 billion worth of IG issuance last week and it would be easily absorbed, I think people would be surprised by that in isolation. So what does it take to actually bring the rubber band back in, to have it snap?
Yeah, I think that's the right question to ask. So one factor is growth. I mean, credit is a growth sensitive asset. So, moderation is great for credit. Growth expectations kind of coming down maybe to the lower end of 2%, high ones, that's still okay. But, our tracking estimate at Morgan Stanley has got down to kind of 1.4 for this quarter. I think if that drops another couple of tenths, then you're starting to flirt with kind of a 1% number, which I think the market would read as too low. I also think the decline in yields can be a bit of a dangerous dynamic. Initially, that decline in yields is great. It means that the total return on the bond fund that investors are holding is getting better. That can attract inflows. But I think as you break down below, say, 4% in the U.S. 10-year yield, and our expectation is that U.S. yields will continue to fall over the course of this year, we think that could sap some demand as those yield buyers step back. So, I think it's the growth data that's going to matter most, that people are going to be most focused on. But I think the decline in yields, that could turn from, an ally into an enemy as it progresses.
It's going to be interesting to see what yield flashes red at the White House on the Treasury market for Scott Bessent. If the U.S. elasticity is becoming more fragile in credit, then how much more elasticity is there in European credit, given the fiscal shift and narrative in Europe, Andrew?
Yeah, so I think this is one of the genuinely interesting dynamics. I think some of the developments over the last week in Europe were good. We saw a larger than expected German fiscal plan. Our economists think that's good. Our economists have taken, up the risks to European growth, or up the outlook to European growth at the same time that we're downgrading the outlook to the U.S. The ECB cut rates at a time where we think the Fed is going to be very hesitant to cut rates in the U.S. We only have one cut in 2025. I think the market in the U.S. is close to 3 cuts as their base case. So, Europe, we have the growth forecast going in a better direction. We have the ECB, which we think is going to be able to deliver more than the market expects in contrast with less. Europe has rarely been able to completely decouple from the U.S., but it does seem to be in a better place. And so we think it should have somewhat more resilience, and that resilience we think going forward can continue.
Yeah, who knew that building the wall would be the wall of worry that we were going to get for the U.S.? But Andrew, I just wonder how bad the economic data actually is, because a lot of it seemed to hinge on sentiment survey. And then we get the ISM. The services actually wasn't bad. The official reading wasn't too bad. How much about this moment is vibes versus an actual fundamental shift?
Yeah, so I think it's an important debate, right? Because a dynamic that investors always need to face, and certainly credit investors need to face, is that by the time that the hard data is really weakening, it's often historically too late. Markets move ahead of the hard economic data. And so I think that's why the market's so focused on these more leading economic indicators. Confidence has, not always, but on a number of instances, confidence is more of a leading indicator, because people first get worried and then later they actually pull back their spending, and then later that kind of actually shows up in the data. So, we do think confidence measures need to be respected. And a survey like ISM PMI, the manufacturing survey, a survey that I like quite a bit, I think the underlying details of that, of weaker new orders but higher prices paid, that's just kind of the worst of both worlds when it comes to potential for weakness down the line, and then difficulty for the Fed to react to that. So I think the market is right to be focused on some of these more leading indicators that have been weaker. I also, again, going back to what you mentioned at the top of this program, the weakness in commodities, the weakness in oil, signaling somewhat greater weakness in the cyclical economy. I think that should also be taken seriously. And that's both a a segment within credit, but that also we see has some leading indicator aspects as well.
Yeah, oil prices reaching a 3-year low last week, which I think people would be forgiven if they missed, given everything else that was going on. Andrew, so wonderful to have you on. Thank you so much for joining us this morning. That is Andrew Sheets of Morgan Stanley. Oil prices, again, have been falling. Stocks at the lows of this morning, down more than 1% in the future session. Let's get some other top stories that are trending on the terminal this morning. China's consumer inflation has turned negative for the first time since 2021. Strategists are now worried that prices could be near contraction for the rest of the year. Economists estimate that it could rebound to near zero in March, and deflationary pressures are likely to persist unless government addresses excess capacity.
TSMC's revenue increased 39% in the first 2 months, driven by resilient demand for AI chips. That compares with a 34% growth during the full year for 2024. Its growth is seen as a sign of healthy spending on AI computing. However, TSMC faces uncertainty through 2025, including potential U.S. tariffs on chip imports, which could impact the business.
TikTok faces a deadline of April 5th to strike a deal for its U.S. operations or be banned from the country. President Trump spoke to reporters on whether a deal for the social video app is in the future.
There could be. We're dealing with 4 different groups, and a lot of people want it, and it's up to me. So there could be.
Coming up on the show, more on President Trump's pivot in economic messaging. That's next on Bloomberg.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
That was President Trump on Fox News responding to a question as to whether he thought that there would be a recession coming. Notably, he did not say that there wouldn't be, but said there would be a transition. His plea for patience was also a similar tone struck by his Treasury Secretary, Scott Bessent. On Friday, he spoke with CNBC, saying the market and the economy have just become hooked and we've become addicted to government spending. There's going to be a detox period. Joining us now is Bloomberg's Kevin Whitelaw. Kevin, this seems to be a very specific message coming from the White House, though we should mention that the Commerce Secretary did speak to Meet the Press, saying that there would not be a recession. But what does this new tone coming from Treasury Secretary Bessent and President Trump suggest about a put of sorts coming from the White House?
Well, I do think some of this is about managing expectations and trying to figure out how to spin what look like some, slightly worrying numbers about sort of where the U.S. economy is headed. But, I think more broadly, I think Trump has talked a lot about tariffs. He's talked about applying them for several different reasons. And I think a lot of the world was hoping that this would mostly be a negotiating tactic where he'd threaten things, people would make some kind of deal, and then the threat of tariffs would go away. I think some of this is suggesting that the tariffs indeed are really seen as potentially more of a structural change for the way Trump wants the economy to work, and that is going to be more of a long-term effect with an adjustment period. And obviously, in the short term and perhaps the medium term, that's going to mean inflation. It's going to mean a hit to GDP, and it's not obviously really clear whether his strategy would succeed in the long run. But he's got to find a way to start getting people to accept that there may well be some short-term economic pain, which was not something that he campaigned on at all.
Indeed, and as Treasury Secretary said, it's more about the call option that you want to focus on, perhaps not the put option. Kevin, we've also got the House with a stopgap bill coming through. Doesn't contain any permanent spending cuts. It's upping the defense spending. This is razor-thin numbers that we're dealing with here to get this through, and the president calling for unity to push it through the House.
Yeah, it's going to be a very tough thing to get through in the House. Democrats really have no reason to help Republicans out on this one, and there are Republicans who have just been long opposed to the idea of any kind of continuing resolution, anything that sort of maintains current spending. There are some minor cuts. There are some tweaks. There are some things the Democrats don't like. The harder path is going to be in the Senate, where obviously they're going to need Democratic votes to get it through in a more significant way. And at the same time, it's not really clear that Democrats want to have a shutdown fight over this right now. So that's going to be the political choice they have to make about whether or not the cuts in this particular bill are really worth going to political war over.
Okay, Kevin, thank you very much. Kevin Whitelaw, the very latest from Washington. This sell-off is accelerating. Danny and I are tracking this for you. Bond market yields are falling, but on the stock side, the market really is absorbing these comments from the weekend. A detox period, as Treasury Secretary said, and this period of transition, Danny, it really is about a dissipation of the belief in a Trump put at the moment in these markets.
Exactly. Trump's not coming to the rescue, but we're going to catch up with Thierry Wizman, I'm pleased to say, later in the hour, who talks about this idea that the brinkmanship that Trump is playing with tariffs also maybe extends to this economy and recession. NASDAQ futures taking the worst of the beating, down 1.1%. Okay, coming up, Carney in, Trudeau out. We're going to discuss the challenges that lay ahead for Canada's incoming leader. All of that's to come on your brief.
Get you set up with your front pages from around the world. First up, the FT. It kicks it off with Ukraine. They will try to persuade the U.S. to resume intelligence and military aid this week. And President Trump said that he has largely lifted the intelligence sharing freeze, and he hopes to push both Ukraine and Russia to negotiating table to broker a peace deal. U.S. pressure on Kyiv has forced Zelensky's administration to shift its position after a meeting at the White House.
Next up, we have this on the Bloomberg that Chinese tariffs on many American farm products have officially come into effect. They run from 10% to 15%, a long list of items that includes grains, proteins, cotton, fresh produce. Traders have been asked to limit overseas purchases of grain, while shipments of soybeans have been delayed.
Yeah, Mark Carney's up for the fight on that. We'll talk more about that in a moment. The Wall Street Journal leads with Mark Carney winning the race to become the new Canadian Prime Minister. He will succeed Justin Trudeau, just as President Trump's administration threatens its economic future. Now, Carney won the contest to lead the Liberal Party of Canada with nearly 86% of that vote. Joining us now with a little bit more is a Bloomberg Daybreak editor, Mark Perrier. Mark, good to see you this morning. Look, Carney is now officially the party leader. It's fighting talk out of him last night. But what lies ahead? He's had a strong vote. Does he go straight to calling the election?
Well, that's the big question. The party's behind him. Obviously, he's got to get Canadians behind him. Once sworn in this week, he can basically call an election. Does he do it? Does he wait a little longer? That's the big question. My thoughts is that he'll probably go on the early side just to capture that momentum.
You look at the language that Mark Carney is already using, saying that retaliatory tariffs stay on until the U.S. shows respect. Mark, there has been this trend of foreign leaders standing up to Trump, helping their politics. Claudia Sheinbaum having a whopping 80+% approval rating from her country. Is there a scenario here where Mark Carney acting tougher helps him win the general election?
I think it does. Canadians are pretty angry right now with the situation, having to modify how they do business, what products they purchase. They are firmly behind whoever will lead in the general election. The message is we're not going to take these tariffs. We're going to impose our own tariffs. So I think the resolve is very much there to fight as a united country. And it'll be interesting to see how both nations repair their ties. These are two fantastic neighbors. They'll need to work on improving these ties as well.
Well, Carney talks about dark days, and this is a fight that they didn't call. We're seeing various sort of headline actions taken over these tariffs, from electricity threats into the USA to Starlink contracts. How are the tariffs actually impacting Canadians?
The mood is, again, as I said, angry. People are, in supermarkets are basically trying to avoid buying U.S. products. Very difficult to do, obviously, as both economies are so tied together. It's having a major impact on supply chains. Some people are canceling their trips to the U.S. There's very much a rise in patriotism. But again, I think most Canadians understand we need a fix to this in order to repair the damage that has been done to relations between both countries.
Yep, goes further than just booing at a hockey game, although that's definitely an element of it. Mark, thank you so much. There's our Bloomberg Daybreak editor, Mark Perrier. And just a quick disclaimer for our viewers that Mark Carney is also the chair of Bloomberg. All right, as we head to break, a quick look at these markets this morning. You're at the lows of the S&P 500 future session with a 10-year yield that is also moving lower by 4.5 basis points. Coming up, from policy uncertainty to government efficiency drives, we're going to discuss slowdown risks with Thierry Wizman. That's coming up next on Your Brief. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
No pain, no gain. President Trump declines to rule out a recession and says the U.S. faces a period of transition. Those comments weigh on Treasury yields and equity markets after stocks posted their worst week since September. And Canada has a new Prime Minister. Mark Carney demands respect from the U.S. and vows to take on the tariff fight. Danny, good morning.
Good morning. The Sunday scaries seeping in to Monday. We are off some of the lows, but still lower this morning by nearly 1% for your S&P 500 futures. Morgan Stanley's Mike Wilson says that U.S. stocks are at risk of slumping another 5%, that some of these worries are going to start to hit corporate earnings from both tariffs and lower fiscal spend. Meanwhile, the bond market gets a bid. Remarkable to see where yield levels are, considering that Germany just had the biggest sell-off since reunification in 1990. Your U.S. 10-year yield at 4.25. Your 2-year yield, that goes lower by another 5 basis points at 3.9, Manus.
Yep, Danny, there certainly is some kind of a snap in the band. I think Andrew Sheets sort of referred to it, the elasticity of these markets, the credit markets specifically, where some kind of sort of a very tight moment. And the risk is that you just push it all a little bit too far and you accidentally break something. And that's essentially what Ed Yardeni is talking about this morning. The risk of a flash crash.
Well, when you have these transition periods in markets, they're really marked by periods of volatility. And I think one of the questions we have to ask, are we still in that transition period where we're volatile and we're trying to find a new trend? Or is this the new trend? Is lower risk assets and weaker dollar, is this a trend that's going to be sustainable?
Well, cross assets, you talked about it multiple times, which is the negative feedback loop of the wealth effect. And that has a much more profound impact on the U.S. consumer than perhaps we've experienced thus far. Nobody's calling it a doom loop, but it is about trigger points. And sometimes things accidentally get broken in markets, the unintended consequences of both actions and rhetoric.
Is the White House willing to get us to that trigger point? Certainly the tone has changed from the White House, with President Trump echoing Treasury Secretary Scott Bessent over the weekend on what's ahead for the nation. He was asked, is a recession coming? Listen to his response.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Macquarie's Thierry Wizman writing this, that there is a risk that too much policy uncertainty ensues to cause a recession. But that risk, too, is exploitable through brinksmanship. By feigning that he'd allow a recession, Trump improves his advantage even more. We still think that ultimately it is mainly concessions rather than permanent tariffs that will ensue. Thierry joins us now. I'm pleased to say he is the global FX and rate strategist at Macquarie Group. Thierry, so great to see you this morning. And this is the question and the hope so many people have abandoned, that Trump coming in to save things because markets turn so much isn't going to happen because of the tone shift. Are you kind of pushing back on this idea that the put is completely evaporated?
Not really. There's always going to be a level where things get so bad that even the U.S., despite the fact that it might have the more dominant position with regard to its negotiating counterparties, would relent here. Ultimately, I think that if you had a recession that was that bad, Trump would see the Republican majority at risk in the midterm elections, let alone what's going to happen to Republicans in 4 years from now. So there is always a level. The question is, where is that level? And the reason we bring up brinkmanship is because obviously this is a Cold War concept. It's been around for 60 years. John Foster Dulles in 1956, James Reston at the New York Times, Thomas Schelling, his famous book Strategy and Conflict, talked about this in the context of the Cold War, that one negotiator may want to feign or pretend that he's willing to take things over the brink to get a negotiating advantage. And I think this is, in some respects, explains why President Trump is willing to talk about a recession, because he knows that once he talks about a recession, his negotiating counterparts will think that it's okay by him, or at least a mild recession is okay, and they'd be more willing to relent on these issues.
It almost feels like a pincer moment between Bessent, the Treasury Secretary, talking about a detox, a fiscal detox, and President Trump talking about this discomfort which is to come. If they were worrying at 480, where is the trigger point in the bond market? Because that is what Scott Bessent and the President have told us they are focused on. We're at 425 now, so where do they blink in bonds?
Well, they certainly don't blink while bond yields are coming down.
It helps them, I know, from an economic point of view.
Absolutely. I think
But at a certain point, it shows recession, doesn't
it? It does, but I don't think that they're going to measure the extent of the recession by the extent of bond yields and how much they go back down by. They're going to measure the recession more by what you alluded to earlier, the wealth effect that might come out of a very weak stock market. No, absolutely not. To them, I think lower bond yields are a benefit. Think about it. It would be a mitigating factor for any recession that might otherwise ensue anyway. You get lower bond yields, you get lower mortgage rates, you certainly get consumers feeling they can borrow potentially at a lower rate. But more importantly, it ultimately gets the Federal Reserve potentially to cut in view of the inversion of the curve that might ensue. They certainly don't want to see an inversion. And then you get another benefit potentially, or at least another offset to the prospect of a recession. So no, I think they're okay with lower bond yields.
To the point of the Fed, and this has been talked about, this idea that the uncertainty, I mean, the Fed themselves has been talking about it. Bostic has been talking about it, that his view could change rapidly, that the uncertainty in policy means that they kind of have to be on hold, that threat of inflation means that they can't move. But as they're on hold because of the policy uncertainty is also causing economic pain. So at what point, what is the bar for the Fed to start to cut, even if we don't have certainty in policy coming out of the White House?
This is still a Federal Reserve that respects a dual mandate. So I think and they also, it happens to be a Federal Reserve that is increasingly watching the data. I mean, they've said that for the last few years. So it really all comes down to the unemployment rate. I don't think it comes down to growth. There's at least some people on the FOMC are still Phillips curve oriented. They're going to watch the output gap. They're going to interpret the output gap through the unemployment rate. And if the unemployment rate were to rise significantly as a result of this policy uncertainty, which certainly is a factor in business decisions and delays of undertakings, whether it's employment or investment, if that happens, I think the Fed would move. But we're nowhere near there now. I think they see 4.1% unemployment rates. That's sufficiently low and really uninteresting at this point to motivate them to cut.
Going back to the narrative that we had from Andrew Sheets at Morgan Stanley, where he talked about a taut market and elasticity, there's an inelasticity or some kind of break point. Do you feel that we're at a very taut point in these markets?
I do, but I still think that plays to the advantage of the negotiators on the U.S. side here. The fact that the market has come down and conceivably can come down more because of the wealth effect or whatever other reasons we would cite, I think they're seeing it as a bit of an advantage. Again, that's only one reason why they're allowing this to happen now. There is an international discussion taking place with regard to tariffs and regard to the orientation of the U.S.'s role. Of course, there is also the need to reduce the deficit. I think that is an imperative on the part of this administration. Scott Bessent had said very early on that he wants to get the deficit to 3%. And keep in mind, a recession that would be caused by a debt crisis in the U.S. would be much worse than the kind of recession we would get through a fiscal contraction, including everything that's happening at Doge or anything that's happening with regard to trade uncertainty. So if it's a question of choosing between the very bad recession and the mild recession, I would take the mild recession any day of the week.
It just feels like this bizarre world where we're talking about some form of austerity in the U.S. while Europe is running higher deficits or plans to, doing more spending. And it's a very short-term memory. It wasn't that long ago that fear of higher deficits in Europe sent the currency falling. It's the opposite now, and you point this out, too, that we have a currency that's strengthening. How sustainable is that?
It is sustainable as long as Europe follows through. And I want to highlight that if all Europe did was spend more and get their deficits higher, I think Europe would be in trouble ultimately, because these concerns about debt to GDP ratios and high deficits and sovereign risk would recur. What Europe needs to do is not just spend more. Europe needs to reorient and restructure its economy so that trend growth goes up, so that when you see these high deficits, it's not as fearsome, not as worrisome as it would be in the context of low growth. What Europe doesn't need right now is high deficits and low growth. High deficits with high growth that would mitigate the ultimate trajectory of the debt to GDP ratio would be okay, tolerable to the market. And I think in those conditions, the euro could continue to do well.
And this is something that came up last week, the distance between promises, rhetoric, and actually delivery on the fiscal front. This is what Mark McCormick questioned in terms of the actual delivery. When you see that flow into the euro and that spread move between US bonds and the Bund, does that continue? Because there have been really, really quite punchy moves in the bond spread over the past sort of 5-6 days.
It can't continue. I think there are a lot of people who doubt the premise that the Europeans will actually follow through on the amount of defense spending and infrastructure spending and spending on digitization and all of the other spending programs that they discussed. The reason they doubt this is, in fact, because they see the bond yield rise and they say, effectively the opposite of the U.S., right? We're seeing bond yields fall. They see bond yields rise. They say that will be the constraint on the amount of spending, because ultimately it will cause other deleterious effects, including pressure on the household to stop spending. But I actually think that the Europeans might very well be successful this time in following through. And I think ultimately that also depends on what President Trump says, right? As long as he keeps the pressure on with regard to leaving NATO, the pressure will be on for them to continue to spend. So this is not just dependent on what the Europeans want, it's also dependent on what President Trump wants and what he says.
Yep, there's plenty of mileage left on this road. Terry, thank you very much. Terry Wizman there of Macquarie Group. Setting the agenda this Monday morning. There are other stories trending on your Bloomberg terminal. Let's get you up to speed. China's consumer inflation has turned negative for the first time since 2021. Global banks are now worried that prices could hover near a contraction territory for the rest of this year. Economists estimate it could rebound to near zero in March, and deflationary pressures are likely to persist until the government addresses excess capacity.
Deliveroo will be closing its Hong Kong business after weak sales in the city weighed on their international division. The London-based delivery company has been facing stiff competition and price wars in China from Foodpanda and Kita. The delivery app will remain active in Hong Kong until April 7th.
TikTok faces a deadline of April the 5th to strike a deal for its U.S. operations or be banned from the country. President Trump spoke to reporters on whether a deal for the social video app is in the future.
There could be. We're dealing with 4 different groups, and a lot of people want it, and it's up to me. So there could be.
Coming up, the president deflects concerns of a slowdown after his early economic plans start to weigh on markets. Futures down this morning. We're going to have more from Washington, D.C. on deck on your Bloomberg Brief. This is Bloomberg Brief, and you're looking live at the principal room. Coming up later today, an interview with the Chipotle CEO, Scott Boatwright. That's at 3:30 p.m. Eastern, 7:30 p.m. in London on Bloomberg.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
That was President Trump responding directly to a question from Fox News as to whether there'd be an economic slowdown. Again, he doesn't necessarily say no. Treasury Secretary Scott Bessent delivered a similar message on Friday, saying the market and the economy have just become hooked and we've become addicted to this government spending. There's going to be a detox period. Bloomberg's Mike Shepard joins us now from Washington, D.C. Mike, it is a different tone coming from the White House. Is there a suggestion that this is a White House that is trying to get all the bad stuff out of the way right now, that this is a feature of them doing all the bad things that might hurt the economy first before the midterms for what they see as gains down the road?
Well, Danny, they are trying to get ahead of the message now coming from Wall Street about some of the uncertainty that investors are seeing from Trump's policies less than 2 months into his second term in office. And that is namely tariffs, but also the uncertainty created by the wave of moves by DOGE into government agencies. All of this has created a little bit of frisson of uncertainty for investors about, okay, what about all the gains that you were promising? Why are all these tariffs being imposed and then taken away and then maybe threatened only a month later? And businesses and investors really thrive in having a little bit of that predictability when it comes to regulation, when it comes to import levies, and that they're seeing less of that. The longer we get into this administration, the less that they're actually liking it. And we've seen equity slide 6% from their peak about 3 weeks ago. And all of the bravado that we had seen right after the election, that this pro-growth agenda really would not only juice markets and preserve gains, but would also send the economy in the right direction. It's giving way to a different sentiment altogether, that some of these policies, especially tariffs, will come at some kind of cost. And we saw the concerns expressed last week by automakers who had gone in to lobby the president, really seeking almost desperately to get a bit of relief, a break from the tariffs that have been promised against Canada and Mexico. They did get a bit of a pause, but it's only a pause. And now investors and companies must now assess, okay, so what is going to happen now? What is going to happen not just like tomorrow, but a month from now and 6 weeks from now? And the president is promising, instead of just all gain, he is signaling that there may be some pain involved too.
Yeah, well, Scott Bessent said there is no put, but you want to focus on the core, which is the policy side. There's only so many times you can get relief in this market. Let's talk about Washington, because this week they're racing to avoid this government shutdown, aren't they, Shep? Ahead of the Saturday deadline, there's a new spending bill, and there's a lot of pressure here on the margins are very, very tight in this Congress to get a bill through.
Well, they really are, Manus. And this is just another bit of uncertainty that President Donald Trump and his administration really want to avoid. In addition to all the uncertainty kicked up by the tariffs, the last thing they want to see is a government shutdown that would maybe signal that the party is struggling to manage affairs here in Washington. Mike Johnson is really trying to get this bill through the House first without very many Democratic votes at all. But it'll be tough because conservatives have typically punted on or avoided voting for altogether these kinds of stopgap spending bills. Trump sees this as important. It's a stepping stone to his bigger legislative goals in Congress, which include, of course, those big tax cuts and also spending cuts, the kind of which that Elon Musk is trying to set the stage for as well with his DOGE initiative. So this will be a big week for Johnson, and we'll have to see whether Democrats use this as some sort of a weapon against Trump and Musk.
Meanwhile, early this week, we're going to have some of the tech leaders in this industry meeting with President Trump. Our understanding from sources is that it will be HP, Intel, IBM, and Qualcomm. Shep, one thing these companies have in common is that they're in the computer hardware industry, an industry which might be impacted by tariffs and trade policy. What are they likely to be talking to and asking the president of?
Well, it's very much a tariff-focused conversation. You know, the White House has listed this as a closed-door meeting. They haven't even divulged who will be attending. But certainly for all these tech leaders, they are going to be talking to the president about what the tariffs on Canada, Mexico, and China are going to mean for their businesses and what the risks are there. And maybe making a case for other changes in policy as well, especially when it comes to artificial intelligence and the course that Trump is trying to set there. And likewise on some of the chips-related restrictions the Biden administration had imposed before leaving office. These also had ripple effects on the hardware providers. We're not sure whether NVIDIA will actually be sending a representative, but what happens with NVIDIA very much sets the direction in a lot of other ways for other companies. So they're going to be watching this very closely over the coming day.
Indeed. Mike, thank you very much. Mike Shepherd with the very latest on the political front. And speaking of tech, let's just focus in on that. TSMC's revenue climbed 39% That was during the first 2 months of 2025, driven by resilient demand for, you got it, AI chips. Tom McKenzie is tracking this story. Tom, the details on this. Strong numbers for February. Revenue up 43%. We should take a good news letter from this.
Top line, I think this is good news. Top line, it confirms that spend around AI and AI chips continues. TSMC, of course, the owner of those foundries that actually punches the chips out themselves over that first 2 months, then almost 40% in terms of the revenue increase. That compares to a 34% increase overall for 2024. Analysts see growth in terms of revenues this year for maybe 40, maybe 41%. There is no let-up, it seems, in terms of that AI spend. And it follows, by the way, the commentary from Broadcom, but also Honhai, otherwise known as Foxconn, suggesting that they are also seeing that similar demand. The demand around these AI accelerators seems to continue as the hyperscalers commit to hundreds of billions of dollars of extra spend on that capex through this year.
It's also looking at some of the commentary from the CEO saying that the TSMC is asking for fairness in U.S. policy, adding that it's not investing in the U.S. for subsidies, but rather because of customer demand. What is the line that TSMC is walking with American policy?
It's a very difficult balance, isn't it, Danny? They are investing. They invested $100 billion. They announced an additional $100 billion investment just last week. C.C. Wei, the CEO, alongside President Trump. That builds on an already existing $65 billion. So in total, $165 billion worth of investment, massive investments in the U.S. to build out foundries. That continues. The risks for TSMC still are the tariff impact. And Trump has talked about the fact he's claimed that Taiwan has stolen semiconductor technology from the U.S. So clearly that seems to be a concern going forward for the Trump administration. They could impose tariffs on semiconductors coming into the U.S. market. The other risk, and he touched on this, or you quoted him on this, is the subsidies coming through from the CHIPS Act. President Trump's been very clear, and you heard that in that speech last week. He wants that CHIPS Act to end. TSMC has benefited from that to the tune of $6.6 billion US. If that's removed, that could impact margins by between 2 to 3%, according to Bloomberg Intelligence.
Yeah, that horrible act, as he refers to it. Tom, thank you very much. Tom McKenzie with the very latest. Coming up, CPI, the deadline for metal tariffs. It's going to be a busy week, again, on Bloomberg.
Let's get you set up for this trading week. President Trump is set to meet with tech CEOs today to discuss trade policy and U.S. manufacturing. On Wednesday, we're going to get the latest CPI data, along with the U.S. deadline to impose 25% steel and aluminum tariffs on the EU. Manis.
Danny, a few stocks to watch. Tesla leading the Mag 7 lower again, along with NVIDIA. This market sell-off has intensified. I think we've just looked at it. It's just off the lows. Airbnb, you've got a little bit of a bid there. Jefferies raising to a buy. The price target 185, and DoorDash also gaining as the food delivery service added to the S&P 500 along with Williams Sonoma. They are entering the index. Danny.
And we are looking at stocks as a whole, Manis, still moving lower off the low as Bruce Kasman over at JP Morgan writing that we see a material higher risk of a global recession this year due to U.S. policies. They put those odds of a global recession, Manis, at 40%.
And that is high. Just Edward Denny went from 20 to 30% in this space of a week. It's about positioning as well. I mean, we definitely are off the lows of the morning. Deutsche Bank say the market is now slightly underweight in a relative sense, but they still see dusting off the lower call at 5,300, 8% lower than here. Dust off your downside.
Yep. And meanwhile, the message from the White House is you got to accept the pain for now for a longer term gain. All right, that is it for Bloomberg Brief. Surveillance will take the reins from here.